13F season has come and gone. The top super investors in the world revealed their portfolio moves for all to see. Today, we are looking at 5 of these investors and will attempt to glean any themes or lessons we can draw from these portfolios. Their moves can provide insight into broader trends in the market or how they view a particular business. Also, one stock in particular stole the show when it came to buys last quarter, a stock I sold earlier in the year, and now it seems to be an investor darling. Welcome to The Quality Investor. We are reviewing the portfolios of 5 super investors today. I want to discuss their major moves, why they made them, and what lesson we can draw from them. The 5 investors are Dev Kantasaria's Valley Forge Capital, Chuck Akri's fund, Terry Smith's Fundsmith, Chris Hohn's TCI fund, and the ultimate super investor himself, Warren Buffett's Berkshire Hathaway. And make sure to watch to the end to discover the latest investor darling that the super investors are spearheading. Let's get right into the portfolios. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. This is Dev Kantasaria's portfolio from Valley Forge Capital Management. Dev Kantasaria is known for his highly concentrated portfolio, as well as holding extremely strong moat stocks. And as you can see, they are also duopolies. You have the S&P Global and Moody's, MasterCard and Visa. He is also known for his very low turnover, and we can see that again as his only reduction here is Intuit. He did not add anything to his portfolio, either new or current. But what's interesting about Intuit is this is the 3rd quarter in a row he has reduced his stake in that. While he hasn't publicly disclosed why he has been selling Intuit, the simplest explanation I can think of is that he views this as a stretched valuation, and he's either taking a little bit of profit or giving himself a little bit more cash so he can wait for better opportunities in the market. Looking at the activity here for Intuit since Q1 of 2019, you can see he has steadily increased his position in the business, and given these reported prices, probably has a fairly low cost basis, so I can imagine he's already received a nice return. Chuck Akri, on the other hand, was pretty active this quarter in terms of his buying and selling. He has added 2 new additions to his portfolio, Copart and FICO. I'll have something to say on that in a second, as well as making a couple sizable reductions and selling out of one stock completely. The stock he had sold out of is Digital Bridge Group. He sold 100% of that stake here, but he did make a sizable reduction in O'Reilly Automotive and in American Tower Corp. Now, Akri mentioned that he wanted to increase his cash holdings earlier in the year, so it's possible that the American Tower Corp sale could be a part of that strategy. It's also been a very long-term holding. He has owned it since the late 2000s, and depending on when he has sold, it potentially has a 5x return, so he could simply be taking some profits here as well. It's also possible he's moving over to higher growth areas. Airbnb, a more recent addition to his portfolio, and CC Intelligent Solutions are 2 beneficiaries of his additions in this quarter. And another point about American Tower is that it is a maturing industry, meaning there could be a slower runway of growth because of the saturation of wireless networks, and we've been in a higher interest rate environment, which dissuades new building. Again, that's speculation, but it is a significant reduction nonetheless. The O'Reilly Automotive sale, on the other hand, continues a trend of consistent selling in every single quarter since Q1 of 2022. And again, the speculation here is that Akri may view this now as a very mature business, has over 6,000 stores, and that could limit the further upside in expansion, and he might be taking some profit as well as stacking some cash to move into some higher growth areas. It's also noteworthy that he did buy FICO with some of his cash in this quarter. You can see now that's valued at $16.7 million here. Now the reported price, of course, is at $1,827. It's hard to know if that's exactly what he bought the shares at, but what we do know is that FICO crashed very hard in late May. It did recover quickly, but if he took advantage of that crash in May, and then hopefully he's taking advantage of the current drawdown again here in late July and August, then he's definitely setting himself up for some growth in the future. I just recently did a video on FICO and why I personally added it to my portfolio. I think there is a very nice opportunity here in FICO. Please check out that video. Terry Smith was again very active in this quarter, reducing many of his positions here in the portfolio, especially large reductions to Meta and Microsoft. And strictly in terms of percentages, some of his largest reductions were to VeriSign, Verisk, and MasterCard, although they're also very small portions of the portfolio, so not too significant in terms of overall movement. More than anything, it seems like he's simply taking some profits and trimming his portfolio amidst some very stretched valuations. We do know we're on quite the bull run in the market right now, and especially in the larger tech businesses, we're definitely starting to see some pretty stretched valuations. Meta and Microsoft could be profit taking, as well as using those proceeds to bump up a position he had started with Intuit. Again, a very strong business that I believe has a very long growth run right ahead of it, as well as some new buys here. We have Vertiv Holdings, Manhattan Associates, a business I've contemplated adding, but just have never really been comfortable enough to pull the trigger, and Napco Security Technologies. It is well known that Terry Smith likes to focus on businesses he believes are staples within the economy, and his portfolio is certainly a reflection of that. And it just looks like he was doing a little bit of rebalancing and some profit taking amidst stretched valuations in Q2 of 2025. Chris Hone of TCI Fund Management is another highly concentrated portfolio. And the biggest theme that emerged here was his selling of Google. Not just the Class A shares, but also the Class C shares. You can see he made a reduction of 6% in the Class C and a 22% reduction in the Class A. But what is more interesting is we're starting to see that theme of reduction in Google emerging. You can see he started selling off in Q1 his Class A shares and began selling his Class C shares in Q4 of 2024. Chris Hone has stated in the past that he views Google as his riskiest holding, and he is very risk averse in nature. You can see his holdings are all very high quality businesses with very wide moats or incredibly high barriers to entry, such as the railways. And he's even stated that in Q1, Google was his worst performer and it lagged his peers such as GE Aerospace, which is now his top holding. And that actually contributed to his decision to reduce the exposure. And there's also broader worries about the slowing ad revenue growth, which is true. I'm a very big Google bull, but not because of the ad business. He's also cited the intensifying competition from OpenAI and Microsoft and the regulatory headwinds from the ongoing US antitrust trials. And that still does remain a risk for Google. If the judge forces them to sell their core search business, Google will be split in two. But again, I've maintained that my thesis around Google is in Google Cloud Platform and in YouTube, not in the core search business. Although I do believe the core search business will remain a part of Google and contribute to its growth going forward, just not as much as those other two. But it is interesting to see Chris Hone reduce his position there. And then of course, it looks like he used those proceeds to beef up his Visa and S&P Global positions. And finally, we have Warren Buffett of Berkshire Hathaway. Easily the widest covered portfolio in the investment chattering space. I'm not going to go over all of his buys and sells in this quarter, but there is one in particular I do want to point out, and that is United Health. And that has sparked a pretty nice rally for United Health in the market. They had been really beaten down in 2025 amid a myriad of issues, many external, some internal. I direct you to the video I did on United Health when I sold completely out of my position back in March of 2025, luckily before it fell off a cliff. But this was seen as wide confirmation that United Health is about to reverse its fortunes and continue to climb again. We shall see. But either way, Buffett did add $1.57 billion of United Health to his portfolio. Now, there is speculation that Buffett himself did not make this purchase, that it was one of his lieutenants in Todd Combs or Ted Weschler. And it's very possible that's true. I mean, Buffett's retiring at the end of the year, so I can see that he's probably delegating more and more of his investment decision responsibilities to his lieutenants. Either way, my view on United Health is that purely from a number standpoint, it's incredibly undervalued. And if you believe that their risk is not that serious with the regulatory risk from the DOJ, as well as a lot of the internal upheaval that we've seen at United Health, both the assassination in late 2024 of the United Healthcare CEO and the abrupt departure of the United Health Group CEO earlier in 2025. There's just been a lot of volatility going on right now with United Health. And for me, has reduced the predictability of the stock, and I believe there were just simply better opportunities out there. It has fallen to such a drastic level, however, that it has made it a very mouth-watering valuation at this point, but I can certainly see a strong justification in adding more United Health to a portfolio. United Health has also seen a strong uptick in insider buying, particularly in May of 2025, which is usually a good indicator that the insiders believe that many of these issues are overblown and that things are going to get better. They would not buy unless they believed that they could stand a profit. So United Health has a lot going for it. And that leads me to my next point. Of all the super investor portfolios tracked on Datarama here, in the S&P 500, United Health was the #1 most bought stock in Q2 of 2025. You can see David Tepper added to it, Michael Burry, another very big name, Christopher Davis, Dodge & Cox, and of course the aforementioned Buffett. So United Health has also become a super investor darling as well, which leads me to believe that these super investors also believe these risks to be quite immaterial. So you can see the 1-year chart here, it turned pretty negative in late 2024. This was right after the assassination. Kind of recovered a little bit in March here, but then just fell off a cliff after the DOJ announced its investigation for insider trading. We also had the abrupt departure of the CEO, Andrew Whitty, and the sentiment has not been very good since. You can see it's just kind of trended downwards. But since that Buffett buy, there has been a big spike back upwards above $300 a share for United Health, and many investors in the investing community believe that United Health is going to recover from here. We shall see. They do post strong numbers every single quarter. If they can reduce some of their medical care ratio costs, keep posting 10, 12% revenue growth every single quarter, and continue to grow that free cash flow, hey, United Health will be back. And like I said, based on numbers alone, they are a strong buy. The only caution I have there is you have to weigh the regulatory risk along with them executing on their internal plan and growing the business. But just to close out, these are the top buys in the quarter. We have United Health, of course, followed by Amazon and Google. I personally have added quite a bit of Google and Amazon to my own portfolio. And as always, the Mag 7 are dominating the top buys in the top 10 here: Meta, Nvidia, Microsoft, Apple. If you look down here, it is interesting to see that FICO only had 2 buys in this quarter. But in my opinion, the investors were waiting for FICO to fall even more because it was widely expected that the alternative credit score would be approved. And that did happen in July. And we saw another big fall in July for FICO. I'm willing to bet next quarter we're going to see a lot of buys for FICO, that it will be one of the more bought stocks for the super investors. But all in all, this quarter seemed to be a theme of reducing some of the top positions, taking some profits, and then adding strategically to some newer positions for our super investors. And as always, we'll check back in next quarter to see what the super investors do and what sort of lessons we can learn again. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.